Hello, good morning from a foggy old Monday the 28th. I'm FX Plu and this is the Market Brief. And I want to start with a quick reminder of Economics 101. In times of rising inflation, monetary policy should be tightened to contract the money supply via higher interest rates. However, in the current environment, most of the inflation we have has only been created from one side of the economy. So far, wages have not really risen that much. Most of the economic stimulus has been artificial. That's been to help the country get past the pandemic. And as such, many from the Bank of England were lured into the belief, good morning, that it was all transitory and may even level out without the need for policy intervention. However, one of the key, perhaps even one of the unexpected elements to affect the inflationary landscape was that of wholesale gas prices. Prices have been heading higher for over a year now. And this was largely driven by demand from China as their economy emerged from their own pandemic lockdown and the factories reopened, demanding gas. And the demand for gas increased significantly, and it saw them prepared to pay whatever it took to secure the supplies. So in the UK, when that was added to the national insurance contribution hike and the higher consumer price cap, it will hit UK consumers right in the wallet. And then the interest rate hikes needed to help control inflation will hit homeowners hard as mortgage costs will increase. Now, last week, the Office for Budget Responsibility was on. They believe that all this will contribute to the standard of living falling to its lowest level in 55 years. So keep an eye out for the quarterly bulletin from the Bank of England this week. It's not usually a market mover, but there is plenty of interest around the bank's estimates for growth and inflation for the rest of the year, and indeed what path it may project for interest rates as well. Keep an eye on that one. In the market last week, sterling dollar was trapped between support at around 130.40 and resistance at 132.80. We opened the new week near the middle of that range, around 131.40, and we are around 120 against the euro. Over in the US, it's a pretty similar story. Despite the country being close to a net exporter of energy, the forecourt fuel prices continue to rise, and sentiment suggests that the Fed may now be prepared to do more to tackle inflation. Last week we had several Fed members on. They were all talking up a 50 basis point rate hike, and some even believe that the rate hike needs to be combined with shrinking the Fed's balance sheet too. One to keep an eye on. Meanwhile, money markets are pricing in 2% of rate hikes this year, and coincidentally that would leave rates close to 2.5% at year end, which has been forecast as the neutral rate. The neutral rate is where interest rates are neither stimulating nor cooling the economy. But given how logistics bottlenecks have helped push inflation higher, as those pressures ease a little, we may see inflation fall a little naturally, and in turn that would bring that natural rate down a little lower. However, much of that will all depend on the outcome of the war in Ukraine, so plenty to play for there. Now, it's Non-Farm Friday this week. Yes, it is April the 1st on Friday, but no jokes, we will be having a sweepstake. Before that, we've got data for house prices, job openings, private sector employment, Q4 GDP and weekly jobless claims. So with all that going on, we should have a pretty good lead in to get non-farm payrolls right on the money this month, don't you think? Well, no, that was a joke, and we can probably still expect our bids to be way off the mark when the data comes out. But hey, we still live in hope. Join me again tomorrow. Toodaloo.
If you do not have a clue, then just tweet through and ask FX Blue.